$2.1 trillion. It's a number so big it's hard to even picture. It's not just a statistic though. It's the weight of the concrete poured into the foundation of the American dream. More specifically, it's the total value of mortgage-backed securities sitting right now on the balance sheet of the Federal Reserve. You've been told to watch interest rates, to follow the jobs reports, and listen to experts argue about a soft landing for the economy. But that's all a distraction. While the news focused on the drama of rate hikes, the real money was doing something much quieter and much more dangerous. It was locking the doors on the housing market. This is the design of a trap. A trap built not with steel, but with complex financial instruments. And right now, millions of Americans are standing right in the middle of it. To understand why the housing market feels so broken, why it feels like nobody can buy and nobody can sell, we have to look at what the Fed did. During the pandemic, the Federal Reserve essentially bought the housing market. Not every house, of course, but the debt that powers it. They scooped up $2.7 trillion in mortgage-backed securities to push interest rates down to historic lows. They flooded the system with cheap money, and it created an illusion of wealth. It made your home's estimated value look like a winning lottery ticket. But now, that cheap money is gone. The Fed is doing what's called quantitative tightening. They're letting that $2.1 trillion pile of mortgage debt slowly roll off their books. They were the biggest buyer in the market, and now they've left the building. This brings us to the trap mechanism. The media calls it the lock-in effect. That sounds harmless, maybe even like a safety feature. It's not. It's a state of paralysis for the entire market. Here's the simple math of your confinement. Millions of Americans are holding onto 30-year fixed mortgages with interest rates around 3%. Today, the market rate is hovering near 7%. So if you wanted to sell your home and move, you'd have to trade a $2,000 monthly payment for a $4,000 monthly payment for the exact same house. Who would do that? This huge gap between old rates and new rates is the core of the trap. It has completely destroyed housing inventory. The market has become a museum where you can look but you can't touch because the price of admission is your financial future. But the mechanism is even deeper than just homeowners refusing to sell. We need to talk about the banking system. Banks use these mortgage-backed securities as high-quality collateral to borrow cash overnight and keep the global financial system running smoothly. But as interest rates rose, the value of those old bonds paying 3% plummeted. Think about it. If you hold a bond paying 3% when you can get 5% anywhere else, your bond is basically worthless. Banks are sitting on hundreds of billions in unrealized losses on these securities. On paper, many are technically insolvent. They can't lend money freely. They can't stimulate the economy. They are zombie banks just shuffling along, terrified that too many people will ask for their deposits back at once. So where does this all lead? To understand the endgame, we have to look back to 1980. Back then, Fed Chairman Paul Volcker crushed inflation by raising interest rates to nearly 20%. It was brutal, but it worked. But the economy of 1980 had a debt to GDP ratio of about 30%. Today, we're approaching 125%. The math is completely different now. We can't do what Volcker did. If rates went that high today, the interest payments on the national debt alone would consume the entire federal tax revenue. The system would mathematically collapse. So they chose a different path, a strategy called financial repression. This means they let inflation run hot while keeping interest rates just high enough to squeeze the middle class, but not high enough to bankrupt the government itself. History shows us this playbook. After World War II, the US did the same thing to pay off its massive war debt. They capped interest rates and forced savers to lose money in real terms year after year. Today, the war isn't overseas. The war is being fought on the Federal Reserve's balance sheet. And the biggest casualty is your ability to own a home. Now let's look forward about 24 months. The story you're being sold is date the rate, marry the house. Just buy now and refinance later. This is dangerously optimistic. Here's the more likely scenario. A wall of maturities is hitting commercial real estate right now. trillions of dollars in loans for office buildings and apartment complexes are coming due. These loans were made when rates were low, and they can't be refinanced at today's high rates. The buildings are now worth less than the debt owed on them. When these big developers start to default, the regional banks that hold their loans will start to buckle. We already saw a preview of this with Silicon Valley Bank. That was just a tremor. The real earthquake is still coming. As regional banks tighten their lending standards to survive, that credit crunch will spill over into the residential housing market. Jumbo loans will be harder to get. Home equity lines of credit will vanish. The only buyers left with cash won't be families. They'll be large institutions. This is the endgame of the trap. The Fed needs to get that $2.1 trillion in mortgage debt off its books. Who has enough cash to buy it? Not you, not your neighbors, private equity firms. These firms have raised record amounts of dry powder. Cash just sitting on the sidelines, waiting for prices to crash. They are waiting for the moment when everyone else is forced to sell. In the next 12 to 24 months, we will see the rise of the build-to-rent model. Entire neighborhoods of new homes will be built not for sale, but for permanent rental. You'll live in a house, you'll mow the lawn, you'll pay the HOA fees, but you will never build any equity. You'll become a renter in a suburb owned by a hedge fund hundreds of miles away. The Fed's trap ensures that current homeowners can never afford to leave, and new buyers can never afford to enter. The only way to unfreeze a market like this is a shock to the system, and that shock usually means a price correction so violent it wipes out the equity of the middle class, allowing the big fish to swallow up all the smaller ones. They call it a correction, as if something is being fixed. But nothing is being fixed. Wealth is simply being transferred from one group to another. There's a famous indicator in finance called the yield curve. Historically, a recession doesn't start when the curve inverts. It starts when it snaps back to normal. That process has already begun. It's a signal that the market suddenly realizes the future is much riskier than we thought. What you are witnessing is the end of an era, the closing of an asset class for ordinary people. The $2.1 trillion trap wasn't an accident. It was the price of keeping the illusion of a healthy economy alive for just a couple more years. And now, the bill is coming due. The trap is set. The mechanism is grinding. And the silence you hear in the housing market today isn't peace. It's the deep breath before the plunge. History doesn't repeat itself, but it certainly does rhyme. Thanks for watching and subscribe to see the pattern.